Meet Steve Schwarzman, the man behind Blackstone, a company on the verge of becoming America's biggest private equity firm. But for Steve, the empire isn't complete. He needs one more piece of the puzzle: Equity Office Properties, America's largest real estate trust, valued at over $30 billion. Built by Zell, a real estate titan known for his daring risks, Equity Office boasts over 500 premium offices across the country. It's the embodiment of one of America's greatest real estate booms. However, a storm brews beneath the surface, and Zell knows it. While the market celebrates, Zell senses the time is right to cash in. Yet, he never expected a buyer for Equity Office. Surely, it's too big to be acquired. The stock hovers around $40 a share, but Schwarzman sees an undervalued gem. He offers $42 a share, turning heads and drawing others into the bidding war. Despite initial resistance, Zell is tempted by Blackstone's revised offer of $47.5 a share. But why, Sam wonders, would Schwarzman buy real estate at the bubble's peak? Schwarzman's plan emerges: sell off the properties piecemeal for higher profits. Zell, whose life work would be dismantled, searches for a buyer who respects his legacy. Enter RNA Realty with a surprising bid of $52 a share, pledging to keep the properties intact. But Schwarzman isn't backing down. He raises the offer to $52.25 a share, displaying a confidence bordering on arrogance. Now, Zell faces a dilemma: sell to the highest bidder or preserve his life's work. Rewind to 1939, when Nazi Germany and the Soviet Union sign a non-aggression pact. Zell's father, Bernard, a Polish Jew, senses danger. He hastily boards his family onto the last train out of Poland before Nazi bombings destroy the tracks. Sam is born in the United States, just 100 days after his family's escape. They're broke but determined to thrive in their new homeland. Sam's father achieves the American dream with a successful jewelry business. Sam, however, has a different path in mind. As a child, he shows a unique entrepreneurial flair, selling Playboy magazines for a profit. In school, he may not be a top student like his siblings, but he's a street-smart hustler. To prove himself to his father, Sam focuses on finding a business opportunity. He spots a chance in a 15-unit student apartment. Despite having no experience, he pitches to the owners and is hired as a manager. His insight as a student sets him apart from other managers. He redesigns the apartments to appeal to the younger generation, and his properties become a hit. Zell starts buying his own properties, using the income from his property management job. He enrolls in law school, though uninterested, as a backup plan in case his real estate ventures fail. But soon, he realizes he's not cut out for the meticulous work of a lawyer. His unique vision and big picture thinking are better suited for the world of real estate. Zell applies to 44 law firms, only to be rejected by 43. Finally, he finds a job through family connections. However, it quickly becomes clear that he's not meant for the legal profession. Instead, Zell chooses to focus on building his real estate empire. And so, the story of Sam Zell, the real estate tycoon, begins. He's not just a businessman but a visionary who knows how to take risks and build an empire. Now, with the fate of his life's work hanging in the balance, Zell faces the toughest decision of his career. Sam Zell, realizing the potential of the booming real estate market, quits his job after only 4 days to pursue real estate full-time. However, he knows he can't succeed on his own and needs to leverage other people's money to scale his business. By owning properties in college towns, he had experienced some success, so he decided to focus on that niche. In 1966, Sam raised capital from 20 wealthy investors, including his father, targeting universities in smaller cities across the US, where growth was rapid. His first big investment was a 99-unit apartment building near the University of Toledo, which cost $1 million. He had calculated the worst-case scenario would yield an 8% return, but the potential upside was 19%. Sam believed that there was an undersupply of quality apartments for students. He redesigned the interior to appeal to young people and raised the rent. Within a year, the asset was generating cash flows, resulting in a 20% return. With no competition, Sam could produce exceptional margins. Impressed by his success, investors doubled their investments in bigger properties. By 1971, at 30 years old, Sam had become a millionaire, but for him, it was just the beginning. Opportunities were endless. He invested $10 million in the Broadway Plaza in Los Angeles. To him, scale was essential for becoming a major player in finance. However, his investment success also made him a target. In the 1970s, the real estate investment trust industry was booming, attracting global capital. Sam had built a portfolio worth hundreds of millions but didn't realize he was being targeted. His brother-in-law, Roger Basks, had been his tax attorney on many real estate deals. Roger, a Harvard-trained lawyer with a spotless reputation, was Sam's go-to person for tax-related real estate matters. In the mid-70 seconds, Sam was working on acquiring a high-rise hotel in Reno, Nevada, with complex tax implications. He hired his brother-in-law to handle the taxes. However, Roger's law firm came under investigation by the IRS, and both Sam and Roger were indicted on charges of tax fraud. Sam's real estate empire was now at risk. If convicted, Sam would lose everything he had worked for over the past 15 years. Fortunately, Sam was dismissed without charges, but Roger wasn't as lucky. This brush with the IRS left a mark on Sam's record, but he was determined to overcome it. He vowed to build a business so large and powerful that no one would dare to hurt him again. Growing his real estate business, however, required more money for bigger projects. His encounter with the IRS made potential investors skeptical, and the real estate market had become overly saturated by the mid-70 seconds, making it hard to find profitable investments. Sheldon does something surprising. He stops buying any more properties, even though the real estate market seemed strong. Everyone thought he was crazy because the buildings were still full of tenants and companies were still hiring. But Zell wasn't swayed by what everyone else was saying. He had always been a daring risk taker, but he was also a practical investor with a deep understanding of real estate. What really set him apart was his confidence in his own views, even if they went against popular opinion. When the real estate market crashes, Zell quickly starts buying distressed properties on the verge of default, often with just $1 down payments. Between 1974 and 1977, Zell buys about $4 billion in assets. His bold actions and clever financial strategies pay off, and investors are eager to join in. By the mid-1980s, Zell has built a real estate investment powerhouse, making hundreds of millions of dollars a year. He has been successful investing in distressed real estate, but Zell wonders if he can also turn around struggling companies. He decides to find out by entering the corporate takeover business. The 1980s were a time of corporate raiders, as low interest rates and lower corporate taxes led to easy money. The era was marked by excess, as many Wall Street titans made fortunes by taking over companies, raising stock prices by firing management, cutting costs, and making big promises. After 2 decades of deal-making, Zell had become a well-known real estate investor. He owned a large portfolio of residential and commercial properties that brought in hundreds of millions a year. But Zell had bigger ambitions. He believed that if he could turn around struggling properties, he could do the same with struggling companies. Why not apply the same principles that work in real estate to buying other things? Zell thought he had the skills and the capital. All he needed was an opportunity. In 1983, Zell found his target. To be a great investor, Zell believed you had to be a lifelong student. He spent his life reading and digesting information to stay up to date and make better judgments and assess risks. Decision-making, he believed, was both a science and a skill that could be taught and learned. Zell saw an opportunity in a company called Ittle, a leasing company that owned aircraft, rail cars, and shipping containers. After early success, the company's management had squandered its resources on extravagant parties and bonuses, leading to bankruptcy in 1981. It re-emerged in 1983 with an uncertain future. Zell, who preferred physical assets, saw value in Ittle's tangible assets. He bought 5% of the company and asked for a board seat, but the board dismissed him. Undeterred, Zell bought 22% of the company and launched a hostile takeover. After a year of fighting, he took over the company and became the chairman and CEO. Zell wasn't welcomed by the board and shareholders, so he had to prove himself with tangible results. His first step as CEO was to cut costs by selling underperforming divisions and reducing redundancies. He had a simple plan: find the most profitable business and focus on that. After cutting costs and liquidating assets, Zell had accumulated $50 million of capital to invest in Ittle's main business, the rail car industry. In 1979, the industry had built over 100,000 rail cars, but the bubble burst in 1981. During this time, 65% of the existing rail cars were scrapped, but demand remained stable. Zell anticipated a price hike and decided to buy as many discounted rail cars as possible. This turned out to be a great move as the company's revenue skyrocketed. Most big companies would acquire other companies when they had a lot of cash as a way to diversify. But Zell had a different plan. Sander has a knack for succeeding in business. He managed to corner the rail car leasing market, which led to a successful turnaround of it. However, it's not a growth market, and Sam is never content with past achievements. To me, it's always what's next, and I think that's what drives most very successful people, he says. He doesn't care about the money, it's about achievement, winning, and pushing the limits. Turning around a bad company and growing a company can require different leadership styles. But Sam knows that as long as he sticks to the fundamentals and logic, he will find a way. In 1987, he acquires Annixter Brothers, a wiring and cable distribution company, using the consistent cash flow generated from Ittle's rail car rental business. It plans to invest this money to expand Annixter worldwide. This move is risky and goes against Zell's usual strategy of only investing in bargains. But if it succeeds, Annexter could become a continuously profitable business. And it does. By 1992, Annexter is the fastest growing division of Ital, generating close to $1 billion in revenue per year. The success convinces Sam to sell the railcar business to free up capital for better assets. He sells 70,000 railcars to General Motors, earning $2.3 billion. Despite his success, Sam does something unexpected. In 1992, he steps down from the CEO position at Ital. Sam's strength as a financial player is his understanding of the public market. He's excellent at finding investment opportunities and raising the necessary funds. He's skilled at bringing together equities in a way that benefits everyone, but he profits the most. In the 1990s, Sam sees an opportunity in public real estate investment trusts. Public REITs turn bricks and mortar into transparent, predictable, liquid assets. As the largest real estate investor in the country, Sam becomes a board member of a REIT. He raises an additional $3 billion in 1997 and acquires the largest collection of premium office buildings in the country, packaging them all in a REIT. But he doesn't know if Wall Street will buy it. When Sam's REIT goes public, it's the largest real estate portfolio in the world, with over 32 million square feet of commercial offices. The predictability of cash flows, mostly from companies with an average lease term of 7 years, makes the rate very attractive. Sam offers a 5.7% dividend. Equity office properties becomes one of the most sought-after stocks. As the US enters a housing boom by 2006, it becomes a target of a bidding war by wealthy Wall Street firms. This achievement cements Sam's position as a powerful force in finance. But even titans make mistakes, and Sam is about to face the toughest challenge of his career. By 2006, Tribune, a 159-year-old media conglomerate, is struggling. A majority owner of the Chicago Tribune, the La Times, and various news networks, Tribune is having difficulty adjusting to the rise of the internet. After attempts to sell the company to private equity firms, the board of Tribune turns to Sam. We looked at the performance of the Tribune for the 7 years prior to when we bought it. During those 7 years, average revenue declined 3% a year. When we underwrote the deal, we underwrote it at 6% decline each year going forward. The risk-reward of the transaction was extraordinary both ways. Sam says he believes these media brands have long-term value, and with his touch, that value can be unlocked. He proposes a leveraged buyout deal to take the company private. The future of this company is currently right out there in front of us. If we keep operating the way we've been operating in the past, there is no future, Sam declares. L has a straightforward strategy. He trims expenses by eliminating inefficiency and then uses the savings to invest in promising growth opportunities. This approach has worked in the past and could continue to work if market conditions remain the same. Unfortunately, the timing of his takeover of Tribune in 2008 couldn't have been worse. Sam Zell, known as the Grave Dancer for his ability to profit from troubled assets, led an $8.3 billion buyout of Tribune. However, the publisher declared bankruptcy in December. The 2008 housing crisis severely impacted the newspaper industry as struggling businesses slashed their advertising budgets. Zell, used to getting his way after years of corporate battles, found himself facing a force more powerful than any he had encountered before. Even a $650 million rescue loan from JP Morgan couldn't save the company. The world is changing, and Zell suddenly finds himself part of an older generation. The Tribune failure serves as a reminder that even the brightest minds can be humbled by the market. Zell admitted, "I did the Tribune company. I lost $300 million. If it had worked, I would have made $5 billion. I liked that risk-reward ratio. Would he do it again?" Yes, cause the risk-reward ratio was appropriate, he says. Though his era may be ending, at 80, Zell refuses to retire. Retire from what? He asks. "I haven't worked since the 4th day I was in that law firm." Sam Zell, a no-nonsense go-getter, is seen as the embodiment of an older generation of investors. Zell's rise to the top coincides with the widespread prosperity America has experienced since the 1970s. He reveals, "Sometimes my team argues with me. They can't believe we're leaving money on the table, but I want to create an environment where everyone wants to keep playing." As an opportunistic capitalist, Zell indeed plays the market game better than anyone.